Good afternoon. Today, we're hitting it back with another lesson here. We're going to be stepping away from the basics and we're going to be stepping into the intermediate understanding of how to trade in the market. So, let's get right into it. Today's lesson is 2.1, and this is the introduction to trade analysis. So, the first thing we're going to be covering is candlestick structure, otherly known as market structure. So the market is printing, we know, candlesticks, and these candlesticks are creating a structure. So if we take a look, here's a really good example. I found a really good outline here from this trader. You can see here double bottom, a bull flag, a bull pennant, an ascending wedge, a descending wedge, triple top, bear flag, bear pennant, inverted head and shoulders, inverted cup and handle pattern, expanding wedge, cup and handle pattern, head and shoulders pattern, and each of these are patterns you can trade and try to catch the expansions in between them. Or if you're swinging and you are, you're holding long term, maybe you would be looking to hold that long and then look to reinvest more here. And then as the market formed this structure and broke down, maybe this is your signal since it did not break above this previous high that maybe your investment is not going where you thought it was going to be. So let's say you start covering on your positions just to try to protect your equity. But these structures are a way for us to read the market structure that the candlesticks are creating. So within that market structure, you can track the trends. So you can track trends. Specifically, the way I do it is I track trends with swing points. So if I just wanted to give you an example here, right, you would just take a highlighter like this, and you would just track the swing points. Right, you can see there, and it swung there to there, it swung here to here, it swung up here to go swing here, swing up there to swing there, right? That's trend tracking. You can see here from this point, they swung from there up here, they swung down here to up here, they swung from here to up here. See, that's trend tracking. And then if you connect the dots, you can get a little outline of what that structure looks like. Well, right, trend tracking is a huge part. So you have to understand the swing points, and that's going to really help you understand price action a lot more, and it's going to help you understand support and resistance a lot more too. So here's this pretty cool little thing right here. Reversal patterns, continuation patterns, and bilateral patterns. So you can see that double top, very common, head and shoulders, very common, rising wedge, very common. And double bottom, inverse head and shoulders, falling wedge, these continuation patterns, right? Bilateral patterns, and you can see that some of these patterns are used in this right here. So you can literally see that right here within all these patterns here. All of these patterns and the market making these patterns and driving in the directions in which you most likely want them to go. So very cool stuff, pretty powerful. I also liked this cutout right here. You can see that the lower low to lower high to lower low to lower high tracking, right, to a lower low to a lower high to an equal low, establishing support, to an equal high, establishing resistance. The test of supply below support. In liquidity concepts, it's commonly known as a sweep. They're sweeping up the orders underneath here and then rallying out, turning that resistance to support while they make a higher high, higher low, higher high, higher low, and reverse the market. So there'll be patterns, there'll be a pattern here, pattern there, pattern here, pattern there, pattern here. exactly how this outlined here. So it's pattern, 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 right? More patterns, and it's just going to keep creating these things. It's trying to signal you which direction it plans to go. Very cool stuff. You can see here that there's an M right here. It's a double top pattern. Here, right there, you can see another head and shoulders pattern, and this overall inverted cup and handle pattern. So these are pretty powerful. This is pretty powerful stuff. Market structure is a very powerful concept, and not just the patterns. The market structure itself is king, and this is where we're going to realize as technical traders like how massive and how important this is. So, you know, it takes a lot though. It takes a lot to be able to track market structure and understand how to be able to profit from it. And there are these candlestick patterns and observations that you can take place where you're going to be trend tracking, you're going to be applying your support and resistance knowledge to candlestick market structure and find that together they're working together to create something. So a lot of times people see the trend line support and resistance, and that's actually what I have outlined here. You can see that if you just took a quick look here from this low all the way up to this high, so this placement here and this first higher low they established, right? We're connecting that point to that point, and we see that the market, right, or at least we're expecting the market that whenever it touches this point, that it will rally out of it. It'll be support, right? And the price action taking place, right, where there's horizontal support and resistance. So this is a horizontal support and a horizontal support. You can see though when the market breaks this trend line and displaces, right, this is the signal that we're going to sell. And so when the market did displace that, you can see they came to support. They did not rally out of it. They played off of bearish price action. Now that it's taken these lows are now considered bearish, a potential support turn resistance, right? And you can see that when it crashed downward, right, it followed again. It made that first touch, and here's the second touch, and it followed this trend down. And then you can see here when it market reversed, and you can actually kind of see here there's an inverse head and shoulders pattern right here. And it's happening underneath an area where there was almost a double bottom. So you can see literally how it was outlined in, here. You can see, right, they made the head and shoulders here and then moved, right? They made a head and shoulders here after the two lows, it moved. So this is very cool. You can see that they established another support line, right? This is a trend line support. You can see that every single time the market tried to move down lower into this trend line, it was able to rally with it. So you can see that they broke through it and they tried to make it resistance and failed. They just played off of other structure here. There's price action here as well. So if you just wanted to get real close to that, you can say that there's a double bottom and a double bottom neckline retest. Double bottom and then the neckline right here, and there's the retest. That's another form of price action. So you can see here that the price action did in fact play. It returned to the trend line. They could not flip the resistance, right? Or excuse me, they could not turn this trend line and flip it from a support to resistance, and so they just continued to rally through. And then, right, they broke through again, and this time on their retest, they were able to actually, make, you can say, a bearish pennant, and this bearish pennant then broke market structure down further. So if you look at it simply, this first and then the second touch here, and we can see later on in market history, these areas become resistance. And you can see that in these immediate touches, one touch, almost three touches, and the market moved lower. And then it broke out of it and didn't come back to retest it. It didn't have any reason to. There was price action at play. You can see here, right? A resistance here turned support here, right? And we could have also been expecting it to go down here potentially, right? And that would have, these are our support levels where we could be looking to formulate a trade. And so we're just using basically these horizontal and trendline support and resistances to try to be able to track that trend. So that way we're able to catch, for example, we're able to catch these. So boom, boom, comes back up, that's potential trade, right? Comes back up, drops down, that's a potential trade, market breaks down, right? Now it's looking bearish. You see the market pull back, right, to this trend line here. I could even adjust this here to the very first touch here, right here to this very first touch. So let's go ahead. So it made that first touch. So right here we could be looking to trade lower, and then we have the reversal pattern. It breaks out of it, right, and then starts to establish a support. So very cool. And you can see the support here, the support trend line moved up, and then you can see when they broke through it, they actually came back to retest it, and then they were able to consolidate and move lower. So this is support and resistance and trend line. So my bad. This is trend line and horizontal support and resistance. And if you go back in the charts and you study this, you start drawing these lines up, you will begin to realize that yes, market does in fact have this geometrical aspect where it's creating these shapes and patterns, and it's acting on these just drawn up lines. Sounds really weird, and it is. But there are traders who use these as confirmation tools to make sure that they're tracking their trends correctly, and not necessarily signals where the actual market structure like this, where we can actually frame entries and exit points. That's how we basically find trades that are available. So if I just go back up here to this, and you see there's lots of resources here too. There's loads of resources, all kinds of different stuff. So this is basically what I was talking about, where you can see here they have stop, entry, target, and it's trying to show you some outlines here. Head and shoulders, showing you how to trade it, right? Very interesting, right? So go ahead and just look up, market structure patterns. You'll find a lot, and try to apply them to the chart, like this outline right here shows. Try to apply that to the chart. It'll teach you a lot, So basically, there's just tools for confirmations and confluence when performing a trade analysis. So there's a lot of things to consider. So like on the fundamental side, um, of this, like there's consumer trend analysis, there's historical trend analysis, there's seasonal and temporal trend analysis, there's geographic analysis. All these things can be a part of the fundamental side of investments. It can be on the fundamental side of trading in the Forex market. So whether it's stocks, Forex, bonds, the fundamental side and understanding the reasoning behind what is taking place, this is going to help you have a market insight and be that quote unquote insider trader, just because you are able to actually analyze and excel in the market by having a process, right? And your process is going to help you create an edge over other traders, over the market. That way you can actually be profitable and produce money. So fundamental analysis is very important to coincide with your market structure. So when you're conducting trade analysis, it's not just the technical side, it is also the fundamental side, and making sure that you, right, are investing in the right business and stocks, and that you are also trading a strong or weak currency if you're trying to, analyze whether it's strong or if it's weak. There are fundamental sentiments that are in place. All we have to do is just go online, look it up, search for it. That's the reason why I teach the way I do. I do not think I'm just going to hand you all the answers, but I can encourage you to go out and search and find what you need to know. So the market is really only moving in three ways. So in our trade analysis, we're either going to be selling in a downtrend, right? Or buying in an uptrend. And if there is a range where it is moving sideways, most of the time, there are traders who will trade from resistance to support, right? Most of the time, though, if it's consolidating like this in a sideways range, just stay out of the market and wait for a more clearer signal, a more clearer direction. You're going to be able to protect yourself a lot. You can see that this is real choppy. There's not a whole lot of price movement. That's not optimal. That is not ideal. That's not something you want to trade in. So what our main focus should be is downtrend markets and uptrend markets, and waiting for these ranging markets to break down and give us a favorable direction. So you can see here is Investopedia, man. If you haven't noticed already, I go to Investopedia in every single one of my videos. Investopedia is full of basic market knowledge, core market knowledge. So make sure that you guys are going to Investopedia.com. You can just get a quick takeaway here that market psychology plays a major role as a trader, and investors remember the past and react to changing conditions to anticipate future market movement. So remember, we're not trying to predict, but we are trying to anticipate that future market movement by reading the actual market structure. The market structure is what's going to help us, right, understand and identify which direction we want to join. So, right, that has a big part to your market psychology. So it might be easy to identify these support and resistance areas, but there is a big part in your discipline and the way you manage yourself and your equity, your market psychology, and having a clear understanding, and that gives you the confidence to enter a position. Like, yes, I have a clear understanding of this. It's given me these signals. It's given me these confirmations. Now I can confidently enter the market with an expectation, right, that I may lose money and I also may win money. And that's why I have risk management at play. And if my edge plays, my risk management is in place. If my edge doesn't play, my risk management is in place. So both ways you're protecting yourself. You're protecting yourself before you enter with your analysis, and then you're protecting yourself with your equity by controlling your risk management, with your entries, stops, and take profit levels. Yeah, I mean, support and resistance is very, very cool. It is the basis to helping you understand liquidity and where that liquidity rests. For example, here there's people buying, people buying, people buying, people buying, right? Right. So what happened? Well, you can even go to see that, look, there was this double top pattern and then a drop, right? So there's liquidity. There are sellers resting here, right? On this third part for the triple bottom, they rally above that point specifically, right where people were selling, right? Right where their stop loss would be. And then they sold it down, and then they took the liquidity underneath this triple bottom. So they stopped out the people who were looking to sell, and then they stopped out the people who were looking to buy off this support. And there's even a bigger indication here. You can see here, right? Shoulder, head, shoulder. There's inducing you to sell, right? While simultaneously, they're also swiping liquidity from all the people who are buying. So you'll begin to understand how that works with how you actually trade these patterns, which I will be getting into actually how to trade these patterns. And I'll basically lay out examples like this, where you can see there's a stop, an entry, and a target level, and you can see the market playing out with that edge, right? So you can see they entered there, target was here, stop loss was up here, and then the trade played. So same thing with this double top pattern, right? We can see boom, boom. So we know that their stop loss is above the highs or above the previous high before the break. So what does this mean? This means that there is liquidity in the market that the market can take and it can exchange hands into the institutions. And it's also because the institutions are targeting each other as well. So they want to absorb all of the money they can and have all of their orders filled, right? So that way they can create an expectational order flow, otherly known as a trend. So we're going to trend out of this price after we sweep all of the buyers whose stop losses rested above these lows, as they had the double bottom confirmation, right? The market rallied up, another double bottom overall confirmation, market rallied again, broke structure up to the upside, market touched it again, had a very strong rally, and then again broke structure, and then they boom took out all those buyers. And even though all those buyers had all that confirmation, if their stop losses were resting directly at that low, you can see they took those buyers, they took their orders, they took the liquidity, and then they administered it for themselves and made a run. So the understanding of trade analysis comes from the idea of contracts for difference. Here we are back to the contracts for difference. If you're not understanding contracts for difference, you have to understand that the market is being created by these orders, right? These orders are creating the market. These orders, right, are moving price. And that's what supply and demand is, right? It's supply and demand. So the sellers versus the buyers, and that's all that's going to be moving the market. So we have just a small bit of tools here to start painting a picture and developing a story that we could understand technically, fundamentally, right? A story in which not only do we have a technical, right, signal, a technical understanding, now we're having a fundamental support, we have a fundamental alignment, right? And now we have a market sentiment, and we can trade with that market and develop a bias with that market and produce very amazing results. But this is the basis of knowledge to understand how we can start to track order flow and liquidity and start to generate very good trade analysis. So this is very important, not something to be taken lightly. These are great even if you use supply and demand concepts, you can use these other tools as confirmation tools. But eventually these become so routine for you that you don't even have to draw them on the chart because you can see it all with your eyes while you're looking for other more specific and advanced things. All right, guys, that was my lecture for today. Pretty straightforward, very simple. I'm just going to start off, this with the trade analysis. I'm going to be getting deeper. This is an intermediate understanding, so if you don't feel like you're quite here yet, just go ahead. Look, I have this all outlined for you guys every single video. So just go ahead and just do some Google searches. Try to find out more. Again, pursue core market knowledge. If you guys found value in this video, I'd appreciate it if you guys hit the thumbs up button. If you're new to my channel, I'd appreciate it if you guys subscribed and left a comment. Let me know what I can improve on. Other than that, as always, peace, love, and harmony. Thank you.